The recession was supposed to arrive in 2023. The U.S. Federal Reserve lifted interest rates from near zero to above 5% at the fastest pace in decades. History suggested something would break. Housing would collapse. Unemployment would surge. Banks would stop lending. Instead, the American economy kept expanding, consumers kept spending, and financial markets eventually climbed back toward record highs. That sounds reassuring. I don't think it is. Because every major financial crisis has one habit that repeats with uncomfortable consistency. It rarely begins where everyone is looking. In 2008, investors watched subprime mortgages, but underestimated the machinery built on top of them. In 1998, the problem wasn't Russia alone. It became long-term capital management, a hedge fund whose positions quietly connected dozens of the world's largest banks. In March 2020, the first major crack wasn't even a bank. It was the market for U.S. Treasury securities, the asset the entire financial system treats as the safest collateral on earth. We'll come back to that Treasury market because it may be the most important piece of this story. Here's a number that deserves more attention than it gets. According to the Bank for International Settlements, non-bank financial institutions now control well over $200 trillion in financial assets globally. That includes pension funds, insurance companies, private credit funds, hedge funds, money market funds, and investment managers. Together, they have become larger than much of the traditional banking sector. That's where the center of gravity has been moving. Banks spent 15 years becoming more resilient after the global financial crisis. Regulators forced them to hold more capital. Annual stress tests became routine. Liquidity requirements tightened. Whether you think those reforms went far enough is another debate, but the balance sheets of major banks are undeniably different from what they were in 2007. Risk didn't disappear, it moved. Imagine squeezing one end of a balloon. The air doesn't vanish, it simply finds another place to expand. Financial risk behaves in much the same way. One reason this shift receives surprisingly little public attention is that it doesn't produce dramatic headlines every week. There isn't a daily countdown. Most of the system functions normally until liquidity disappears for a few days, collateral loses value faster than expected, or one institution suddenly has to sell assets into a falling market. That's often enough. And when markets are built on leverage, a small disturbance can travel remarkably far. A dry observation here: financial engineers have spent decades inventing increasingly sophisticated ways to convince themselves that selling the same risk to 3 different institutions somehow makes it less risky. Accounting occasionally agrees. Mathematics sometimes agrees. Reality has a vote as well. Consider what happened in the United Kingdom during September 2022. Government bond yields rose sharply after the government's fiscal announcement. That should have been painful, but manageable. Instead, pension funds using liability-driven investment strategies suddenly faced collateral calls they couldn't meet quickly enough. To raise cash, they began selling the very government bonds whose falling prices had created the problem in the first place. Prices fell further. Collateral demands increased again. The spiral accelerated. The Bank of England stepped in with emergency purchases, not because Britain's largest banks had failed, but because a corner of the pension industry threatened to destabilize one of the world's most important sovereign bond markets. That episode lasted days. Its lesson could last years. Notice what actually happened. The trigger wasn't reckless mortgage lending. It wasn't consumers defaulting. It wasn't a wave of corporate bankruptcies. It was leverage, liquidity, and collateral interacting inside institutions that most people never discuss outside specialist circles. That's a very different map from the one many investors still carry in their heads. There is, of course, a counter-argument. Some economists would say this is exactly why central banks exist. They argue the Federal Reserve, the European Central Bank, and other monetary authorities have developed enough emergency tools to prevent local stress from becoming systemic collapse. After 2008 and 2020, they certainly have more experience than before. I'm not completely convinced. Each rescue teaches markets something. It teaches participants where support is likely to appear. Sometimes that's stabilizing. Sometimes it quietly encourages even larger positions next time. That's a difficult balance, and policymakers know it. My opinion is that we're spending too much time debating where the next crisis will begin geographically, China, the United States, Europe, and not enough time examining which layer of finance has become indispensable without receiving equivalent scrutiny. Here's the question I keep coming back to. If the safest assets in the world increasingly depend on markets that require constant liquidity, what happens during the first week when liquidity simply isn't there? Because history suggests crises don't announce themselves with a headline. They begin with a funding problem that sounds technical enough for everyone else to ignore, until nobody can dot. Remember the Treasury market from the opening. Let's go back to it. The market for U.S. Treasury securities is worth more than $28 trillion. That number is difficult to visualize, so think about what it represents instead. Every major bank, central bank, pension fund, insurance company, sovereign wealth fund, and multinational corporation relies on this market in one way or another. Treasuries aren't simply government debt. They are the financial system's preferred collateral. They are the object institutions borrow against, lend against, and price countless other assets from. If that market functions smoothly, money moves. If it doesn't, even healthy institutions begin acting like frightened ones. That distinction matters. A bank can survive temporary losses if funding remains available. A profitable hedge fund can fail within days if it cannot roll over short-term borrowing. Liquidity and solvency are cousins, not twins. Markets often confuse them during moments of panic. March 2020 demonstrated exactly that. The pandemic was obviously a public health emergency, but the first major financial alarm wasn't triggered by rising infections alone. Investors across the world rushed to raise cash at the same time. Oddly enough, many sold U.S. Treasuries, the very assets normally expected to provide stability. At first glance, that makes no sense. Why sell the safest bonds during a crisis? Because investors weren't asking, what's the safest asset? They were asking, what can I sell today to meet tomorrow morning's obligations? There's a profound difference between those questions. The Federal Reserve ultimately stepped in with massive purchases, restoring confidence and keeping the Treasury market functioning. Many people remember the stimulus checks. Fewer remember that stabilizing the market beneath the global financial system was arguably just as important. That episode exposed something larger. The plumbing had become fragile. This is where non-bank finance enters the story. For decades, commercial banks dominated credit creation. Regulations after 2008 changed that landscape. Higher capital requirements made many traditional lending activities less attractive. Into that space stepped private credit funds, direct lenders, structured investment vehicles, and asset managers. Private credit alone has expanded dramatically over the past 15 years, surpassing $2 trillion in assets under management according to industry estimates. Companies that once borrowed from banks increasingly borrow from investment funds instead. On the surface, this looks like diversification, and to some extent, it is. Supporters argue these funds provide financing to businesses that banks are unwilling or unable to serve. That's a legitimate point. Many middle-market companies have continued growing because alternative lenders filled a genuine gap. The problem isn't that private credit exists. The question is how it behaves when conditions deteriorate. Banks operate under extensive regulatory oversight. Their capital ratios, liquidity buffers, and stress test results are scrutinized regularly. Private funds face different requirements. Investors understand this, or at least they're supposed to. The difficulty is that financial stress doesn't care about legal categories. If enough funds decide they need cash simultaneously, asset sales become contagious, regardless of whether the seller is called a bank, an insurer, or a private credit manager. Think back to September 2022 in Britain. That wasn't a story about bad loans. It was a story about margin calls arriving faster than institutions could respond. Financial crises often resemble traffic jams more than explosions. Every driver believes they'll keep moving. Then one unexpected stop ripples backward for miles. Here's another example that received less attention than it deserved. In 2021, the collapse of Archegos Capital management cost several global banks more than $10 billion. Archegos wasn't a household name. It operated as a family office, using total return swaps to build enormous leveraged positions without triggering the disclosure rules that ordinary institutional investors faced. Different banks saw different slices of the exposure. Very few saw the whole picture. That's the critical lesson. Modern finance rewards specialization. Every institution knows its own balance sheet in extraordinary detail. Much fewer understand how their counterparties connect with everyone else's. The network itself becomes the blind spot. There's a dry irony here. We've built systems capable of executing millions of trades in milliseconds, yet occasionally discover interconnected risks months after they've accumulated. Speed is not the same thing as visibility. I think that's one of the defining characteristics of modern finance. Information is abundant. Understanding is scarce. Before moving on, it's worth asking a fair question. If these vulnerabilities are visible, why haven't regulators solved them already? Part of the answer is structural. Regulation is largely organized around institutions. Markets evolve around incentives. Capital naturally migrates toward the places where returns remain attractive and constraints are lighter. Close one channel and another usually opens. That's not necessarily regulatory failure. It's the system adapting. But adaptation cuts both ways. The stronger the visible walls become, the more pressure builds in places few people inspect with the same intensity. And that brings us to something that makes this discussion even more complicated. The biggest risk may not be excessive debt. It may be the growing assumption that central banks will always have enough credibility and enough balance sheet to stop the next chain reaction before it escapes the plumbing. We'll test that assumption next. There are reasons to believe it deserves a second look. Central banks have earned a reputation that borders on mythology. A market stumbles, liquidity evaporates, credit freezes. The central bank arrives with emergency lending facilities, asset purchases, swap lines, or some new acronym that didn't exist the week before. Markets recover. Commentators declare the crisis contained. That playbook has worked often enough that many investors have quietly started treating it as part of the financial system itself. I'm less certain. Not because central banks have become weaker overnight, but because every intervention solves one problem while creating another. Take inflation. For nearly 15 years after the global financial crisis, central banks had extraordinary freedom. Inflation stayed subdued despite aggressive monetary policy. If markets required support, policymakers could usually provide it without immediately worrying that consumer prices would spiral. That world changed in 2022. The Federal Reserve, the European Central Bank, and the Bank of England weren't trying to stimulate economies anymore. They were trying to slow them down. Inflation in the United States peaked above 9% in June 2022. Suddenly, rescuing markets and fighting inflation could point in opposite directions. That's an uncomfortable position. Imagine trying to press the accelerator and the brake at the same time. The engine keeps running. The smell tells you something isn't right. This is where the story takes a turn. Until now, we've talked about leverage, collateral, and liquidity as if they're the central characters. They aren't. Confidence is. Every financial system is built on a remarkable act of collective belief. A money market fund assumes tomorrow's withdrawals will be manageable. A bank assumes short-term funding markets will open on Monday morning. Governments assume investors will continue buying their debt at sustainable interest rates. Most days, those assumptions are correct. When they aren't, events move with surprising speed. Remember the British pension funds from earlier? Their immediate problem wasn't insolvency, it was confidence in the collateral chain. Markets stopped behaving the way participants expected, forcing actions that made conditions even worse. That's the reversal in this story. I began by suggesting the next financial crisis may not start inside banks. I still believe that. But I think the deeper issue isn't institutional at all. It's behavioral. The next crisis could begin wherever too many intelligent people make the same reasonable assumption at the same time. History is full of examples. Before 2008, mortgage-backed securities were considered highly diversified. Before 1998, sophisticated mathematical models suggested long-term capital management's positions were manageable. Before Silicon Valley Bank failed in 2023, many depositors assumed their cash would remain where it was because everyone else would do the same. Then everyone reached for the exit together. That's the pattern worth studying. Silicon Valley Bank deserves a closer look because it challenged an old assumption. The bank wasn't brought down primarily by reckless subprime lending. It held a large portfolio of U.S. Treasuries and agency mortgage-backed securities, assets generally viewed as safe. The problem was duration. As interest rates rose rapidly, the market value of those bonds fell. At the same time, many of the bank's technology sector clients needed cash. Withdrawals accelerated. Losses that had existed mostly on paper suddenly became real because assets had to be sold. Within roughly 48 hours, confidence evaporated. 48 hours. In the age of mobile banking, a bank run no longer requires anxious crowds outside branches. It requires functioning Wi-Fi. Technology has made finance more efficient. It has also made panic more efficient. That isn't an argument against technology. It's simply an observation that digital speed compresses decision-making. Rumors spread faster. Withdrawals happen faster. Markets react faster. Regulators have less time to understand what's unfolding before they must respond. Here's the counter-argument, and it's a serious one. Supporters of today's financial architecture would point out that the system absorbed the failures of Silicon Valley Bank, Signature Bank, and Credit Suisse, without triggering a global collapse. That's true. Authorities acted quickly, depositors were protected in key cases, and broader contagion was contained. Those facts deserve acknowledgement. But they don't settle the debate. Sometimes the absence of catastrophe reflects effective crisis management. Sometimes it reflects problems being transferred rather than eliminated. I'm not 100% certain which description will define this period. The evidence leans toward a mixture of both. My opinion is that policymakers have become exceptionally good at extinguishing financial fires. The harder question is whether repeated rescues quietly encourage people to store more fuel. There's another layer that receives surprisingly little public discussion. Governments themselves are carrying far more debt than they were before 2008. Higher interest rates don't only pressure borrowers, they increase governments' own financing costs. That means future central bank interventions may unfold under tighter political and fiscal constraints than they did 15 years ago. That's a very different environment, which leads to a question that doesn't have an easy answer. If the institution expected to rescue markets eventually faces limits of its own, who becomes the lender of confidence? Because confidence, unlike capital, can't simply be printed. Let quotes go back to the sentence that opened this video. The recession was supposed to arrive. Instead, something quieter happened. The global financial system adapted. Businesses found new lenders. Investors found new vehicles. Capital flowed around regulations with the same determination that water finds a crack in concrete. That's one of capitalism's greatest strengths. It's also one of its recurring vulnerabilities. Every improvement changes incentives, and incentives eventually change behavior. That's why I'm skeptical whenever someone confidently predicts the exact source of the next financial crisis. The history simply doesn't support that level of certainty. In 1987, portfolio insurance amplified a stock market crash that many participants believed technology would soften. In 1998, a hedge fund that relied on Nobel Prize-winning mathematical models nearly destabilized the global banking system. In 2008, mortgage defaults became a worldwide banking crisis because leverage had multiplied their impact. In 2020, a pandemic briefly froze the market for U.S. Treasury securities. In 2022, British pension funds unexpectedly required central bank intervention. In 2023, Silicon Valley Bank demonstrated that social media and mobile banking had changed the speed of bank runs. Different triggers, the same underlying pattern. A system becomes increasingly optimized for efficiency until it loses more resilience than anyone intended. That doesn't mean collapse is inevitable. It's important to resist that temptation because financial commentary often swings between two extremes: endless optimism or permanent catastrophe. Reality usually chooses the uncomfortable middle. Markets spend years appearing remarkably stable before reminding everyone that stability isn't the same thing as safety. Those are different concepts. Here's where I think the conversation needs to change. People spend enormous amounts of time asking which country represents the greatest financial risk. Is it China because of its property sector? The United States because of government debt? Europe because of weak growth? Japan because of demographics? Those questions matter, but they're incomplete. Financial crises rarely respect national borders. Modern capital doesn't carry a passport. A pension fund in London may finance projects in North America using collateral linked to Treasury markets, while borrowing through institutions operating across several jurisdictions. A disruption in one market can travel thousands of kilometers before breakfast. That's the nature of interconnected finance. Remember the figure from the beginning, more than $200 trillion managed by non-bank financial institutions. That wasn't just a large number, it was the clue. The center of financial gravity has shifted, while much of the public conversation remains focused on the institutions that dominated 20 years ago. Regulators know this. The Financial Stability Board has repeatedly warned about vulnerabilities in non-bank financial intermediation. The Bank for International Settlements has published detailed research on collateral chains, leverage, and liquidity mismatches. These aren't obscure concerns buried in internet forums. They're appearing in the documents written by the people paid to worry about systemic risk. Whether those warnings translate into effective policy is another matter. A dry observation before we finish. Finance has an extraordinary talent for renaming old risks until they sound innovative enough to attract new investment. The balance sheet usually recognizes them eventually. My opinion is straightforward. The next financial crisis won't begin because one asset class is inherently evil, or because one country suddenly becomes reckless. It will begin because complexity has reached a point where no single institution sees the complete picture. Every participant understands their own exposure. Very few understand the network they collectively create. That's a harder problem to regulate because no one intends to build systemic fragility. It emerges. There's one doubt I still have, and I think it's worth admitting rather than pretending certainty. Artificial intelligence may improve risk detection by identifying hidden connections across markets before humans can. It may also encourage institutions to converge around similar models and similar decisions, making crowded trades even more common. I genuinely don't know which force will dominate. Neither does anyone else, despite confident predictions you'll hear. Here's the prediction I'm willing to stake my reputation on. The next major financial crisis will probably be described in its first week as an isolated technical problem. Analysts will call it contained. Officials will emphasize that the banking system remains well capitalized. Those statements may even be true. The real question will be whether that technical problem sits at the center of a network nobody fully mapped. By the time that answer becomes obvious, markets won't need another explanation. They'll already be repricing the world. If this made you question one assumption you hadn't challenged before, that's time well spent. There are plenty more threads worth pulling, and we'll keep following them.